Welcome to HouseLux Estate, your online hub for all things real estate, finance, and homeownership. This is the place where we demystify the complex world of property investment and financial planning. We aim to provide valuable information that empowers you, whether you're a seasoned homeowner or just considering buying your first property. Our goal is to make the complex simple, breaking down jargon and helping you make informed decisions. Today, we're going to tackle an important topic that impacts us all, whether we're buying a house, starting a business, or just managing our personal finances. The 5 C's of credit. These are the key factors that lenders consider when deciding whether to give you credit. Understanding these factors can help you better manage your credit and improve your financial health. So buckle up as we delve into the fascinating world of credit. Let's kick things off with our first C, character. Now, when we talk about character, we're not referring to your favorite movie or book personality. In the world of credit, character refers to your reputation as a borrower. It's essentially a measure of your trustworthiness and reliability when it comes to handling and repaying debts. You see, lenders are a bit like detectives. They're always on the hunt for clues that can tell them how likely you are to repay a loan on time. One of the main ways they do this is by delving into your credit history. This record of your past borrowing habits and payment behaviors paints a picture of your financial character. If you've consistently paid your bills on time and managed your debts responsibly, lenders will see you as a low-risk borrower with a strong character. But character is more than just your credit history. Lenders also look at your stability. Factors such as how long you've lived at your current address, how long you've been in your current job, and even your personal references can contribute to your character assessment. If you've shown stability in these areas, lenders might see you as more reliable and more likely to meet your repayment obligations. However, it's important to note that a strong character isn't built overnight. It takes time to establish a solid credit history and demonstrate stability. So if you're just starting out on your credit journey, don't be disheartened. Start by making small, responsible credit decisions, and over time, you'll build a strong financial character. Also, bear in mind that even if you've had a few credit missteps in the past, it's never too late to start rebuilding your character. Remember, your character is about your credit future as much as it is about your credit past. By making consistent, on-time payments and showing responsible borrowing habits, you can improve your character and increase your chances of obtaining credit in the future. Remember, a good character can open doors to better credit opportunities. Moving on to our second C, capacity. Capacity is all about your financial ability to repay the loan you're seeking. It's a measure of your financial strength and stability. Lenders want to ensure they're lending money to individuals who have the means to pay it back, and this is where capacity comes into play. Think of capacity as a snapshot of your current financial situation. It's like a financial selfie, if you will. It provides lenders with a clear picture of your income, employment stability, and debt-to-income ratio. Income is the first aspect lenders consider when assessing capacity. They want to know how much money you're bringing in regularly. This could be from a full-time job, a part-time gig, or even a side hustle. What matters is that it's stable and reliable. Employment stability is another crucial factor. A consistent employment history indicates a steady income flow, which in turn increases your capacity. If you've been at your job for a considerable amount of time, that's a good sign. On the other hand, if you've been hopping from job to job, lenders might see that as a red flag. The debt-to-income ratio is another key component of capacity. This ratio is essentially a comparison of your monthly debt payments to your gross monthly income. It gives lenders an idea of how much of your income is already committed to other debts. A high debt-to-income ratio might suggest that you're overextended and might struggle to make new loan payments. So how can you boost your capacity? It's simple. Maintain a stable income and keep your debts low. This could mean sticking with your current job, increasing your income streams, or reducing your existing debts. Every little step you take towards financial stability can significantly improve your capacity. Remember, lenders want to lend to those who demonstrate the ability to repay. By showing that you have a stable income, consistent employment, and a manageable debt-to-income ratio, you're proving that you're a reliable borrower. Maintaining a stable income and low debt levels can significantly boost your capacity. Next up, our third C, capital. Capital, in the context of credit, refers to the assets and investments you have. These could be anything from your savings account, your investments in bonds or stocks, or even the tangible assets you own, like a house or a car. Now, you might be wondering, what does all this have to do with my credit? Well, here's the thing. When lenders are deciding whether or not to give you credit, they want to be sure that you can pay them back. And one of the ways they gauge this is by looking at your capital. You see, your assets and investments are a kind of safety net. If for some reason you're unable to repay your loan, these assets can be used as collateral. In other words, they can be sold off to cover the debt. Think of it this way. If two people are applying for a loan and they have the same income and credit history, but one has more assets than the other, the person with more assets is likely to be seen as more creditworthy. Why? Because they have more capital that can be used to repay the loan if things don't go as planned. So, while it's important to have a good character and the capacity to repay, don't underestimate the importance of capital. The more capital you have, the more creditworthy you appear to lenders. Now, let's talk about the fourth C, collateral. Collateral is a term that might sound a little daunting, but it's simply something of value that you own and agree to give to the lender if you can't repay your loan. Think of it as a safety net for the lender. It's their insurance policy, their backup plan. For instance, let's say you're taking out a mortgage. The collateral in this case would be the house you're buying. If for some reason you can't continue making your mortgage payments, the lender has the right to take your house, a process known as foreclosure. They can then sell it to recover the money they loaned to you. Collateral isn't limited to houses, though. It can also be a car for an auto loan, equipment for a business loan, or even investments for a personal loan. It all depends on the type of loan and the lender's policies. Now, you might be wondering, how much does my collateral need to be worth? The answer is, it varies. But in general, the value of your collateral should at least match the amount of the loan. This way, the lender can feel confident that they can recover their funds if you default. Remember, lenders aren't in the business of owning houses or cars. They're in the business of lending money and getting it back with interest. Collateral is simply a way for them to manage their risk. The value of your collateral can greatly affect the amount of credit you can secure. Finally, we arrive at our fifth C, conditions. Conditions refer to the external and internal factors that lenders take into account when assessing a loan application. These could be economic trends, industry health, or even the political climate, which could all impact your ability to repay the loan. On a more personal level, lenders also consider the purpose of the loan. Are you taking a loan for home renovations or to start a new business? Each purpose carries its own risks and rewards, and lenders will assess these in relation to your financial situation. Furthermore, lenders take into account how you plan to use the funds. Are you investing in assets or paying off debts? The intended use of funds can significantly influence the lender's decision. Understanding the conditions surrounding a loan application is not just about securing approval. It's about negotiating better terms for your loan, ensuring you get the best possible deal. Understanding the conditions can help you negotiate better terms for your loan. So, we've covered the 5 C's of credit. This journey has taken us through character, capacity, capital, collateral, and conditions. We've seen how character, your credit history, can influence a lender's trust in your ability to repay. We've delved into capacity, the examination of your income against your recurring debts. We've explored capital, your own investment that reduces the risk for the lender. We've recognized the role of collateral, an asset that can secure your loan. And finally, we've understood conditions, the external influences that might affect your ability to repay the loan. Each of these elements is fundamental in the credit decision-making process. They collectively paint a picture of your financial health and creditworthiness. Understanding these factors helps you better navigate the world of credit, improving your chances of securing the financial backing you need. Remember to subscribe to House Lux Estate for more insightful content. Until next time, stay financially savvy.